Class, today we're going to go over Chapter 4, which is a continuation of Chapter 3, Supply and Demand, and taking it a step further to talk about aggregate demand and aggregate supply. Now, we're not going to go over all of the topics as outlaid in the chapter because we really need to have this chapter follow some of the topics we haven't studied yet, such as GDP, unemployment, and inflation. The chapter was placed here in the chapter order of the custom book, but it doesn't necessarily need to exactly follow Chapter 3. But what I do want to do is focus on those concepts that we have studied in Chapter 3 and were introduced, and just take them a step farther before we move into some of the more macroeconomic topics. So today we're going to focus on just the law of aggregate demand and the law of aggregate supply, explain them in relation to what we learned last week, and that will be a good preparation for us to move into Chapter 5 next week. So today we're going to talk about aggregate demand and aggregate supply, which is also referred to as an ADAS model. And it is a model that can be used to explain short-run fluctuations in real GDP and the price level. Don't be concerned if you don't understand what GDP is right now. We will explain it in a few minutes. But GDP is basically supply, and the intersection of supply and demand will give us our price level. So we could use an ADAS graph to show or diagram changes in output or changes in price, as we did in our assignments at the end of Chapter 3. The aggregate demand curve is a curve that shows the relationship between the price level and the quantity of real GDP demanded by households, firms, and the government. If you remember last week that GDP was not in the definition of the demand curve or the law of demand, goods and services were. Excuse my writing. Goods and services were. But when we talk about aggregate demand, we're going to talk about real GDP, which we'll see in a moment includes not only consumer demand, but demand by the government and by industries as well. The short-run aggregate supply curve is a curve that shows the relationship in the short run between the price level and the quantity of real GDP supplied by firms. Now, again, this real GDP replaces goods and services supplied by firms in our Chapter 3 lecture. And when we talk about aggregate supply or supply in the short run, we're going to see the differences between the short run and the long run supply curves. Now, since we are talking about the economy as a whole, which is another way of saying macroeconomics, we need these macroeconomic explanations of why the aggregate demand curve has a negative slope or is downward sloping, and why the short-run supply curve has a positive slope or is upward sloping, and finally, why the curves either shift to the left or the right, which indicates a decrease or an increase. Now, we learned in Chapter 3 that the law of demand stated that as the price of a product decreases, the quantity demanded of that product will increase. That accounts for our negative or downward sloping supply curve because of that inverse relationship. Now, let's take out recall because we haven't gone over it yet. But the components of GDP are made up of personal consumption by households, gross private domestic investment by companies and firms, government purchases, and net exports, which can be defined as exports minus imports. If we wanted to write this equation algebraically with y as the variable for GDP, we could come up with this following equation of GDP equals consumption plus investment plus government purchases plus net exports. We can then use these four additional variables and come up with a further explanation that the aggregate demand curve is downward sloping because a fall in the price level increases the quantity of real GDP demanded. Now, even though it uses different words, it follows the same methodology as we learned in Chapter 3. As the price of the product goes down, quantity demanded will increase. Now, we introduced a concept in Chapter 3 called the income effect. And the income effect stated as personal incomes rose, quantity demanded will rise, given a normal good. Something we didn't talk about, but has a similar effect on demand as the income effect, is what's referred to as the wealth effect. When we talk about wealth, wealth is a definition or is defined by the value of someone's assets. Some assets include stocks and bonds, real estate, and collectibles. As the prices of these assets rise and the liabilities that are owed against them fall, a person's wealth increases. Cash is also an asset, but as we'll learn, the value of cash may rise and fall, which will directly affect the price level, which will be a one-to-one relationship. So as the price level rises, the value of these assets will fall because the value of the dollar goes down, and vice versa. So when the price level falls, or we have what's known as deflation, the real value of household wealth rises, and so will consumption and demands in goods for services. This is also called the wealth effect. The wealth effect also has another meaning and another input or effect on demand. As the value of people's assets rise, they feel richer. When they feel richer or wealthier, they tend to save less and spend more of their incomes. When they do that, the wealth effect has the same effect as the income effect, in that aggregate demand or demand will rise because people psychologically sense that the price of products is within or is affordable and within their ability to pay for it. But as we learned and as we've discussed previously, not all purchases are made by the cash that we have available to us in our pockets or in our bank accounts. We don't always live within our means. In order to do that, we need a way to finance our purchases above and beyond what our incomes are. And the primary way of financing these purchases is through the issuance of credit. One of the main drivers of credit are interest rates. Interest rates can have either a positive or negative effect on demand at the consumer level, at the firm level, and at the government level. And the interest rate effect states that a higher price level increases the interest rate and reduces investment spending, and also reduces consumers' abilities to borrow, thereby reducing the quantities of goods and services demanded, and vice versa. As the price level lowers, spending will increase. International trade will affect supply and demand because net exports is part of the GDP calculation. To take a step back, GDP stands for gross domestic product. It is the market value of all final goods and services produced within a market in a given year. So if a product is produced in the United States and sold to a customer in Europe or in Asia, it still is accounted for in the US's GDP. That is called an export. An import is a product that is made internationally and imported to a country. So many of our products that we purchase have been manufactured somewhere else. When they come into this country, they're considered imports. The difference between what a country exports and what it imports is known as net exports. And the net exports will equal the spending by foreign households and firms on goods and services produced in the United States minus the spending by U.S. households and firms on goods and services produced in other countries. A higher price level in the United States relative to that of other countries causes net exports to fall, which will reduce the quantity of goods and services demanded. A lower price level in the United States relative to other countries will cause net exports to rise and increase the quantities of goods and services demanded. Here is a practical and current example. There have been numerous complaints from other manufacturing nations that China artificially keeps its currency low. When a country has a lower or devalued currency, it will take less foreign dollars to purchase those products or those goods and services produced within the country with that devalued currency. So in this instance, it would take less US dollars to purchase products made in China. What this does is it increases or artificially boosts demand for Chinese manufactured products, and thus makes it harder for other manufacturing countries to be competitive. When countries are buying from China, they are manufacturing and they are employing all of their available resources, which means that their economy is growing at a faster rate. So the argument basically boils down to is that in order to keep their economic growth at approximately 10%, China is artificially keeping its currency low just so it could boost exports. Now, exports are really important to China because their domestic consumption is pretty low because the majority of the country is agricultural in nature and lives on very low annual incomes. Now, as with Chapter 3, there is a difference between shifts in aggregate demand and movements along it. When the aggregate demand curve moves to the right or left, that indicates a shift. Whereas we move along different points in a static demand curve, that represents a movement along it. Now, what are the variables that will cause aggregate demand curve to either fall or either decrease or increase, i.e. shift to the left or right? Well, these variables will fall into three categories. They are changes in government policies, changes in the expectations of households and firms, and changes in foreign variables. Government policies include fiscal policy, which is a change in federal tax rates, and government purchases that are intended to achieve macroeconomic policy objectives, which are normally economic growth with low inflation. An increase in government purchases or a decrease in taxes shifts the aggregate demand curve to the right. And a decrease in government purchases or an increase in taxes shifts the aggregate demand curve to the left. Now, taxes reduce consumers' or firms' disposable incomes, which lowers their ability to produce. Government policies also include changes in monetary policy, although the federal government doesn't directly impact monetary policy. In the United States, monetary policy is overseen by the country's central bank, which is the Federal Reserve. The actions that the Federal Reserve takes to manage the money supply and interest rates are referred to as monetary policy. We will study monetary policy more closely in chapters 8 and 9. We will also study fiscal policy more closely in chapters 11. Now, when the Federal Reserve wants to expand economic output, they will increase the money supply, which will result in lower interest rates. When interest rates are lower, the cost of borrowing becomes lower, which makes it easier for consumers and firms and government to finance their additional purchases. When interest rates are lower, the aggregate demand curve will shift to the right. When interest rates are higher and purchases become more expensive, the aggregate demand curve will shift to the left. Changes in the expectations of households and firms will also affect aggregate demand. If households become more optimistic about their future incomes and firms become more optimistic about their future profitability of their current investments, then aggregate demand curve will shift to the right. On the other side, or on the flip side, if they are more pessimistic, the aggregate demand curve will shift to the left. Now, one of the issues that we've had over the last 4 or 5 years is a situation in which we've had very slow growth, even though we've had an environment of very low interest rates. And the reason, or one of the reasons for low growth, is that firms and households still do not have a very optimistic outlook of the future. Firms are not investing because they believe the additional output gained by those additional investments in plant and equipment will not generate a profit strong enough to support that investment. Now, net exports are impacted by changes in numerous foreign variables, as the domestic market is affected by changes in the price level, in interest rates, and in government policy Foreign purchases are affected by changes in variables that affect them both domestically and internationally. So if firms or households are buying fewer U.S. goods, or if U.S. households are buying more imported goods and services, then the aggregate demand curve will shift to the left. What drives these changes? The foreign exchange rate in one country's currency versus the other will drive it. Foreign tastes and preferences and foreign income levels will drive exports and imports. If real GDP in the United States increases faster than real GDP in other countries, net exports will fall. The reason? The income levels in that foreign country and the price level of U.S. products will not be a good match, meaning the prices will be high and the incomes will be too low to purchase, and vice versa. Table 13.1 in Chapter 4 will outline variables that will shift the aggregate demand curve and the reasons for it. If I am cycling through these slides too quickly, feel free to hit the pause button on your controller so that you have some extra time to copy down the notes. Now, because of the effects of the price level on aggregate supply is different in the short run as it is in the long run, we use two separate aggregate supply curves, one for the short run, one for the long run. For the purpose of what we're going to go over, we're going to focus primarily on the short run. But before we do that, I just want to give you a little explanation on why the curves for the long and the short run slope the way they do. In the long run, changes in the price level do not affect the amount of output. The reason being is that both input costs and output prices are fully flexible in the long run, which means firms could adjust their price to keep the same profit level regardless of if the cost of making the product goes up or down. In this case, they keep their profit margins flat. As profit does not increase, the incentive to produce more disappears. So in the long run, firms will produce the same amount of goods and services at every point on the price axis, which means that the long run aggregate supply curve is a vertical line. And the long-run aggregate supply curve shows the relationship between the price level and the quantity of real GDP supplied. When real GDP increases, the long-run supply curve shifts to the right, and that is indicative of economic growth. The short-run supply curve slopes very differently than the long-run supply curve. The short-run supply curve is what we traditionally see in a supply-demand graph. It is upward sloping from left to right. The reason it's upward sloping is because of the direct relationship that price and quantity supplied have with each other. As price goes up, quantity supplied goes up because the profit margin goes up, giving firms incentives to produce more. The reason is that the profit margin goes up because in the short run, costs are relatively fixed. So input costs are relatively fixed, where output prices are relatively flexible. Because of this, profit margins rise and the incentive to produce more increases. What is the biggest what is the biggest cost of any input? And that is labor. Additionally, it's taxes and regulation. All three of these items are not going to move significantly in the short run. The concept of having fixed costs or fixed prices is referred to as being sticky in economics, meaning they are stuck at a certain level in the short run. In the long run, both input and output costs or price are fully flexible. Now, as with demand and as with supply, as we studied in Chapter 3, there are differences between shifts in the short-run aggregate supply curve versus movements along it. The short-run aggregate supply curve tells us or explains the short-run relationship between the price level and the quantity of goods and services firms are willing to supply, holding all other variables other than price and quantity constant. If the price level changes, but other variables remain unchanged, the economy will move up or down a stationary aggregate supply curve. Meaning, if the price level goes up, the willingness for firms to produce additional products will go up. It doesn't mean their ability to produce more has changed, i.e., lowering the price of inputs or increasing their amount of capital stock. So what are some of the variables that will shift the short-run aggregate supply curve? Well, the first are increases in the labor force and increases in capital stock, which, as we know in economics, also refers to plant and equipment. As the labor force and capital stock grow, firms will have the ability to supply more output at every price level. They'll have more people to operate more machines, which could produce more final goods or more final services. Now, This is often referred to in economics as an increase in capital per hours worked. This will have a positive effect on supply, but as taking back to chapter 1, will also have diminishing returns, which means the more hours per capital worked, the less the return or marginal benefit will be. The greater determinant, or the greater the variable that adds the greatest amount of increase in supply, is that of technological change. And technological change doesn't have to refer to an advancement in computer technology. It could also be a change in a manufacturing or production process that eliminates wasteful or unneeded steps and makes the production process more efficient or quicker. So a positive technological change takes place. It will increase the productivity of workers, thus shifting the aggregate supply curve to the left, which means they will produce more goods and services at every price level point. Changes in the price level, say for wage, will also affect short-term or short-run supply. Wage is the price of labor, which is a factor of production or an input. As the price of wages are expected to rise, firms will adjust their wages and prices by that same amount. If we hold all of the variables constant, the supply curve will shift to the left. Why will the supply curve shift to the left if a company is increasing its price to match its increase in cost? Well, as the price level goes up, the cost of inputs go up, and even though they're passing that on to their customers, the price of an increase in the price of inputs will always shift the aggregate supply curve or the supply curve to the left. So if the expected changes in the future price level are greater than a certain anticipated percentage, then the aggregate supply curve will shift accordingly by an equal amount. Now, the only other area I'm going to focus on, or the only other variable I want to focus on as it affects supply, are unexpected changes in the price of an important natural resource. The most important natural resource to our economy is oil. Oil is used not only to heat our homes, to drive us to and from work, or to transport goods and services from warehouses to the stores that we buy them in. It's also used to power plant and machinery, and it's also used in the production of many materials that we use in finished products. So oil is an important input to almost every facet of the manufacturing process. Changes in the price of oil are really outside our control. They are controlled by the countries that develop the oil, which means that at any given point in time, since they exist outside the laws of this country, they could conspire to lower the amount of supply that they're offering, which in turn will keep the price of that commodity higher. This is what's known as a negative supply shock. A supply shock is an unexpected event that causes the short-run aggregate supply curve to shift. In the 1970s, there was an oil embargo imposed on the United States by OPEC, which meant that the price of oil, or the supply of oil, was greatly reduced, which greatly increased the price of oil. At that point in time, inflation started to increase, but production did not increase, even though the price level was going up. And the reason is because the cost of making products increased. Now, on the flip side, we had a positive supply shock in the mid to late 90s. All of the technological change that occurred with all these new internet and networking technologies made the manufacturing process more efficient. That increase in efficiency led to a greater rise in productivity or a greater rise in output, which can be classified as a positive supply shock. Now, the next two slides will show the variables that affect the short-run aggregate supply curve and will cause it to shift to the right or the left. If I cycle through these too quickly, again, just hit the pause button on your player so that you can take the notes. After the next slide, our lecture regarding aggregate demand and aggregate supply will end, and we'll pick it up in a little more detail in class.